Hi, everybody. Chris Thornberg with Beacon Economics. And, a couple weeks ago, I was with Lance Martin, and I was a keynote at his real estate market forecast. Always an honor to be there. If you happen to be there, you might remember we had a few technical difficulties. So as a result of that, I'm here in studio with Coldwell Banker and Lance to do a reprise of what I talked about back then. Now, with that in mind, there's been a few things that have happened over the last few weeks which are worth updating anyway. So it's good we have this opportunity to give you a bit of an outlook as to what's happening in the U.S. economy, the Inland Empire economy, and of course, most important, what's happening in real estate. With all that in mind, let's get right into it. The big news story, of course, over the last 12 months has been the recession that everybody's been expecting. I've shown you, of course, these headlines on a number of occasions. Now, mind you, this kind of forecast recession is going on so long that some folks are calling it the Godot recession because it never quite seems to roll in. And to be clear, there's nothing particularly new here. After all, when you think about this sort of ongoing gluttony of negative headlines, well, we've been seeing this every single year for the last decade. If you remember, I've been referring to this, of course, as miserableism. That is to say, the constant need to tell everybody how tragic everything is, regardless of what the data actually says. Now, to be clear, there certainly has been some mixed economic signals coming into 2023. For example, over the course of last year, we saw a pretty good slowdown in overall economic growth. We saw a big collapse in the University of Michigan Consumer Confidence Survey. For those of you into numerology, you might, of course, have remembered that the yield curve has been inverted for a number of months now. By the way, for those of you wondering what that means, the yield curve is nothing more than the difference between long-run and short-run interest rates. And when short-run interest rates should be up above long-run interest rates, well, that's been a pretty good indication that we're about to have a recession. Now, I'm going to come back to that in just a few minutes and talk about this particular relationship. But of course, the news over the last few months, which make you again concerned about the direction of the economy, was of course the collapse of Silicon Valley Bank and then Signature Bank, and what's been referred to sort of colloquially as a banking crisis over the course of the last couple of months. Yet again, negative news for the economy. Well, with all this in mind, let's also remember one thing. We are not in a recession right now. After all, recession is best characterized as a period of time where the economy is not living up to its potential. That is to say, it's not producing as much in the way of goods and services as it could. Well, right now, unemployment rate is well below 3%. We just got the March number. It's running at 3.5%. January was the lowest number seen since 1968. Industrial production continues to cruise along near an all-time high level. And when you think about Q1, well, it looks like it's coming in at roughly a 2% real growth rate when we get the numbers in just a couple of weeks. In other words, the U.S. economy is not in a recession right now. The economy continues to move forward. In fact, it looks like we have a lot of momentum coming into this year. So it begs the question, what is actually going on out there? Well, before we dive into that, let me make one thing clear. You know, I've called this need to tell everybody how terrible everything is miserableism. But nowadays, I've shifted up just a little bit. Now I tell everybody to beware the narrative. Now, what do I mean by that specifically? Well, a couple of years ago, Robert Shiller, the guy who wrote Irrational Exuberance many years ago about the stock market bubble of the late 90s, he wrote a new book, Narrative Economics. So for me, it was a bit of an epiphany, and I'll tell you why. In this book, he really is pointing a finger at the economics community. He's pointing out that, you know, look, economics deserves a lot of credit for bringing what we call formalization to the field of social sciences. That is to say, math and numbers and empirical methodologies and all sorts of wonderful things. But what Shiller points out is, well, along the way, we may have forgotten that at the bottom of this pile is a human being. It is still a social science. And the reason this is important is one of the inherent underlying assumptions of many of these models we use is the idea that people are inherently rational. They absorb information from the world around them, sort out what's right and what's wrong, and make the best decisions accordingly. Well, when you really think about that, you start to recognize there's something fundamentally wrong here. Because, well, people and our use of data and economic theory, well, that's been around for a couple hundred years. We can also acknowledge on the other side of the fence that we are story-based creatures, and stories in many ways are the things that bind us together as a community. Stories go back to the dawn of civilization. And the idea that the story must follow reality, well, we all know better than that. We know the stories, the myths we all tell each other on a regular basis Ergo, that doesn't make a lot of sense. Now, his broader point is this. When the narrative and the reality are similar, when the stories we tell ourselves and the economic data overlap, this is when our models work. This is when businesses make good decisions, households make good decisions, policymakers are pursuing the right goals. But if the narrative and the reality become disengaged, well, now all bets are off. Suddenly households are doing things they shouldn't be doing. Businesses are making business investment decisions that don't make a lot of sense. Policymakers are pursuing the wrong goals. This is when you need to be worried, because this is when, of course, things start to go haywire. And over the last decade, we've seen this disconnect between narrative and reality that I've called miserablism. But then again, go, of course, before the Great Recession when, well, in 2005, anybody using pick-a-pay loans could just become a real estate millionaire overnight. We know that narrative, of course, was broken and inevitably led to the Great Recession. So as a forecaster, I have to constantly sort of break apart the narrative versus the reality, and this, of course, is what makes our forecasts that much more real, that much more, of course, effective for understanding what's going to happen. So where are we heading? The narrative is pretty obvious. First of all, the economy is already in a crisis. Now, what crisis? Well, again, that's a function of miserablism, right? What crisis probably depends on what party you're in. The left will tell you it's inequality and, of course, the cost of housing. The right will tell you it's taxes and regulations. But again, these are narratives. The more, shall we say, present issue has to do with what's happened over the last year, which, of course, has been the big increase in interest rates, really predicated on the big acceleration of inflation. And inflation, we're all told, is hurting consumers. Real estate is being crushed by interest rates. Ergo, we're going to have a recession. And of course, the banking stresses we're seeing, it's just a sign of the rot at the bottom of the system. On the other hand, I don't buy it. I don't think we're going to have a recession over the next couple of years. Why? Well, first of all, inflation and rising interest rates has been largely mischaracterized in the conversation about it. Inflation and interest rates aren't negative shocks hitting our economy that could push our economy into a recession. Quite the opposite. They're it's the repercussions, it's the result of the choices that our policymakers have made over the last couple of years in response to the pandemic. If you think we are going to have a recession over the next couple of years, for those many folks out there who are quite grim on this particular issue, my question will be, why? Where are the true imbalances in our economy that were going to cause, of course, this big shift in aggregate demand that will lead to a recession-type circumstance? In 2005 and 2006, it was obvious. Consumers were borrowing too much. They were spending too much. Real estate, there was way too much debt, most of it bad debt in the form of having very little underwriting standards. And of course, we were building way too many homes. The problems in our economy were very obvious. Today, I don't see those problems. I just don't. Now, it isn't to say that real estate, mortgage rates going from 2.5% to 7% isn't a problem for the economy. Of course it is. Real estate markets are feeling it profoundly. But underlying drivers of the economy, in particular consumer spending and business investment, will be more than enough to offset the problems we're seeing in those particular sectors. And while asset prices, including home prices, will almost assuredly continue to fall, the underlying fundamentals of those assets, for example, rents and vacancy rates in apartment buildings, are going to remain very strong. So it's going to be an interesting real estate cycle we're going through. One that, yes, is having a lot of problems, of course, in terms of dealing with the big increase in interest rates, but at the same time, the underlying core structure of our economy is just fine. So it's a different kind of real estate cycle, and we're going to come into what it looks like in just a few minutes. Now, it doesn't mean everything's just fine. I have a lot of worries about our economy. For example, the collapse in filtering is going to make our housing shortages, particularly those shortages here in Southern California, that much worse. Labor shortages are an enormous problem across the economy. We have public deficit problems at both the state and federal level. The potential and completely pointless bank credit crisis we're in the midst of right now. But for me, of course, the scariest thing of all is this gap, the gap between the narrative and the reality. We continue to tell each other stories that aren't real once we actually take a look where the economy is. And that, of course, is the biggest problem we face, because until we can start to actually recognize what's going on, it's going to be very hard for us to expect households, businesses, and policymakers to be doing the right things. And therein, of course, lies the long-run challenge. Now, How do we get here? Well, again, miserableism, that particular narrative. We all remember, of course, going back to 2020, the pandemic hit, and there's little doubt the pandemic was a tragic human circumstance. 7 million people plus have passed. We were locked up inside for a year. A huge shock, obviously, to our economy. I get that. But none of that meant this thing was going to turn into this economic disaster the way those headlines read back in the day. It's going to scar the U.S. labor market for the next decade. A leading economist warns of 10 years of depression and debt. 30% of Americans with home loans are going to stop paying. Crazy stuff. None of it made any sense whatsoever because while this was a serious shock, it was a different kind of shock. And it was a shock that was going to pass away relatively quickly, which is exactly what it did. Look, the pandemic caused the deepest recession in U.S. economic history and the shortest. It was 1 quarter long before the economy started recovering, and it's amazing how rapidly it came back, whether you're looking at unemployment or GDP output. However you want to look at it, the economy came roaring back. Now, that story, that is to say, the fact that the economy came roaring back, never made it into DC's collective consciousness. They were still, of course, still stuck in this era of miserableism, in this place where they just had to throw money at the economy like crazy. And as a result of that, well, $6 trillion of fiscal stimulus. Let me put that in context. The Great Recession caused about $1.2 trillion of lost economic output, in response of which Congress did $6 trillion in deficit spending stimulus to support the economy. For every dollar of lost income, we got $5 of money directly from the government. Now, the big question is where'd you get the cash from? Because if they had gone to the debt markets the way Congress typically has to, we're going to borrow $1 trillion this year. You go to the bond markets and you say, hey, there's $1 trillion in securities, we need to sell them off. You couldn't have done it. In 2019, all American debt together grew about $3.5 trillion. It's public and private, real estate and consumer and government, $3.5 trillion. In 2020, had Congress gone to the bond market and tried to borrow $3 trillion just to fund their stimulus spending, the bond market would have absolutely imploded. It wouldn't have worked. The good news for Congress is they didn't have to go to the bond markets. They only had to go to Jerome Powell. They went to the Federal Reserve and requested them to basically provide support through the form of quantitative easing. And Jerome Powell happily agreed. $5 trillion of quantitative easing. In other words, of the $6 trillion in deficit spending done by Congress, of that $6 trillion, $5 trillion was funded by printing money. This was as close to helicopter money as we have ever seen the Federal Reserve rely on, ever in the past. Now, it isn't, by the way, the first time they've used quantitative easing. Ben Bernanke used quantitative easing back in the day, of course, in the wake of the Great Recession. But the circumstances couldn't be more different. Back then, of course, Ben Bernanke did $3.5 trillion in quantitative easing over 6 years in response to a very significant financial shock to the economy. We remember the crisis, right? Bond markets had seized up, tons of foreclosures, banks were failing. Now, why was this significant? Well, what does cause a depression? The answer, by the way, is not a pandemic. What actually causes a depression is, of course, deflation. That is to say, when prices want to fall, and that's typically driven by a contracting money supply. Ben Bernanke is a student of history. He understood that if you look at the Great Depression, the Depression of the 1890s, or many of the depressions we've seen in Europe, time after time, is a combination of a bad recession combined with deflation that caused that depression. So, when the banks started failing and the credit market seized up, he knew this was inherently deflationary. It was causing the money supply to contract, and he did $3.5 trillion in quantitative easing to offset that. This time, it was completely different. This time, there was no financial crisis. And by the way, it wouldn't have mattered if there was or wasn't one, because Jerome Powell didn't even wait to see if one was going to occur. The pandemic hit the U.S. in February of 2020. In late March, he decided to do $5 trillion in quantitative easing. To be clear, it wasn't until April until we even had our first employment numbers about what the pandemic was actually doing to our economy. So without any information whatsoever of what was going to happen or not, he agreed to one of the greatest expansions of money supply we've ever seen. And That's the key. Because there was no financial shock, this helicopter money went straight into the money supply, and you saw one of the greatest increases in money supply seen in the last 100 years of the U.S. economy. I mean, unbelievable. Contrast this to what happened with Ben Bernanke back in the day. $3.5 trillion over 6 years, kept, of course, money supply nice and constant. This time around, $5 trillion of quantitative easing, an enormous increase in the supply of money. Now, what happens when you do that? Again, this is not rocket science. That's the most amazing part about this, is how much of this we absolutely already understand. This is known theory, known data in monetary economics. When you throw that much money, when you increase your money supply by 40% in a year and a half, well, what happens in the very short run, according to, of course, one of the most famous monetary economists of all time, Milton Friedman, well, money illusion kicks in. Everybody suddenly feels rich. We have piles of money in our pockets. And what do you do when you're rich? You invest and spend. Asset prices go up. Interest rates start to drop. Consumer spending takes off. And business investment takes off with it. It feels good. But the key term here, of course, is illusion. It's not real. If the government hands you a pile of dollars, you're not actually richer. Wealth in our world is determined by the ability for a nation to actually produce goods and services. And that's based on labor supply, labor training, infrastructure, institutions, capital investments, functional financial markets, solvent banks. These are the things that actually allow us to produce goods and services. Throwing a bunch of money at that doesn't change any of the underlying circumstances. It creates the vision of wealth without actually creating true wealth. In other words, all it does is it pushes aggregate demand beyond the ability for the economy to meet that demand. And when there's more demand than supply, we all know what happens. Prices go up. Inflation. Ergo, step two, inflation starts to kick in and we go through our hangover period of time. Inflation starts to increase dramatically. With that, interest rates. When interest rates start to come up, asset prices start to sag. Consumer spending goes away, and of course, business investment cools off. You end up exactly where you started. Nothing's really changed except for you have higher prices. But Milton Friedman points out quite rightly, there are long-run negative consequences to the use of this tool. One of the big consequences is the fact that it increases inequality. There's a big transfer of wealth from savers to borrowers, and that can be problematic. Equivalently, of course, you raise the overall risk of investment, and that too can have a long-run negative impact on the economy. This is why he says it's money mischief. You don't want to do it. The Federal Reserve should be left alone to make its money supply decisions in the dark. You don't want politicians taking advantage of this. Well, that was back in the day when the Federal Reserve was truly independent. They aren't independent. Consistent political calcs over the last 15 years has politicized the Federal Reserve, and now the Federal Reserve Board is made up of a group of people who just run with the narrative the same way everybody in Congress does, and they're not making the appropriate decisions. Now, how does this actually work? Well, again, everybody feels rich, everybody starts to spend, and you can see the problems. For example, when all the money hit the economy, you saw a big widening of the U.S. trade deficit. That's a function of the excessive amount of spending. We had all the problems in our supply chains. Of course we did. The supply chains weren't designed to deal with this level of demand. Again, this is a function of that, of course, monetary shock. Now, how it actually works is through the wealth effect. What do I mean by that? Remember, when you make a decision on how much to spend this particular year, it's on a function of your income, but also how much money you have in the bank and how much your 401k is worth, your wealth. So you can see on the left-hand side, there was a big spike in overall household net worth in the United States. Again, that was driven by all this cash thrown at the economy. To put that in context, about $6 trillion in helicopter money turned into about $32 trillion of brand new household net worth. That's about a 25-30% increase, and people were thrilled. They started to spend that. Now, this is not the first wealth bubble we've had. In fact, we've had 3 major wealth bubbles in the last 25 years. Late 90s, that of course was .com. The middle part of last decade, that was subprime. And of course, right now, Jerome's quantitative easing bubble. But to be clear, there's a significant difference as to how this wealth bubble moved through the economy. Take a look on the right-hand side. This is the wealth level for the bottom 50% of American households. And you can see .com, there was no impact on their net worth because, after all, it was an equity game. The bottom 50% doesn't own equities. Subprime was terrible for the bottom 50% because those are the folks who picked up the subprime loans and then got foreclosed on. They ended up worse off. But this time around, Jerome's quantitative easing bubble had one of the biggest impacts on the bottom 50% you could possibly imagine. A 125% increase in net worth for this bottom group. Why is that important? Because this turns into spending. Pay attention to that particular number. So, and to show it to you one other way, here's a graph I got out of the Wall Street Journal the other day. And again, it shows you change in household net worth by income quintile. And again, the bottom quintiles have seen the biggest increase in their net worth over the last couple of years. Very important when you think about core consumer demand in our economy. And of course, we also saw the inflation. Remember, this is part of the illusion. More demand than we actually have the ability to produce supply, and prices start to go up. And it isn't just us, by the way. Turns out most central banks overdid it over the course of the pandemic. Hence, of course, today, most countries are suffering some degree of inflation. Not a surprise. And with inflation, interest rates, of course, have jumped. Take, for example, the 10-year bond. Prior to the pandemic, the 10-year bond was running about 3%. During the pandemic, it got pushed down to 0.5%. Now, of course, it's ricocheted up to 4%. Mortgage rates, prior to the pandemic, had gotten close to 5%. Got pushed down below 3 during the course of the pandemic, and then ricocheted up. They're now running around between 6 and 7%. Now, again, a big shock to the industry, mainly because of the scale of the change. This is one of the biggest increases in interest rates we've ever seen in such a short period of time. But to be clear, we just went from ultra-low interest rates to interest rates that kind of look where they were, say, back in 2004 and 5. So it's almost like a return to a normal interest rate regime. But nobody was anticipating it. Hence, of course, you're seeing a lot of hits here. And with the big increase in interest rates, what goes up must come down. NASDAQ is starting to come down. Home prices are starting to fall. Bitcoin, of course, has lost some of its luster all of a sudden. Not a big surprise here. What is a surprise is the conversation we're having about inflation. Because look, everything I just told you is obvious. This is established monetary economic knowledge. What's amazing to me is that no one can actually acknowledge it. Think about someone like Janet Yellen, the Secretary of the Treasury, who, by the way, has had a long, well-established career in macroeconomics, married to a Nobel Prize winner, George Akerlof, who, by the way, writes books with Robert Shiller, and they were all friends with Milton Friedman back in the day. And yet, she gets in front of a microphone and she says, oh, we didn't anticipate these supply chain issues. That's why we have inflation. What? You know better than this. Of course you do. And how about some of the other excuses you hear in D.C.? Oh, it's the deficit, greedy corporations, not enough manufacturing jobs, Biden's bad green energy policies. Now both the Democrats and the Republicans can all agree it's Putin's fault. But of course, none of this is real. None of this is right. This is the same as saying we have inflation because, Saturn isn't aligned with Jupiter, or because Kim dumped Kanye, or perhaps, of course, it's because LeBron James has lost his mojo. All of this is silly. We all know that inflation is a monetary phenomenon. The only reason we're having inflation in the United States today is because they printed and distributed too much money. But in this world of miserableism, they can't say that out loud. Remember, in the miserablest world that exists in D.C., that exists in Sacramento, 80% of Americans are living hand to mouth. They're one paycheck away from being homeless. Of course, none of that's true. But nevertheless, in that particular world, you can't stand up and say the obvious. Why do we have inflation? Because people are spending too much money. That is not allowed. Ergo, we have to go through all this silliness. But there are consequences to not acknowledging what's actually going on out there. And look, this is one of my favorite examples of this. Think about what happened over the course of the last year. One of the big news stories of 2022 was a big increase in gasoline prices we saw. Gasoline prices went up almost 50% from the beginning of 2022 to the middle of 2022. But remember your old supply and demand graph. If this was just a supply effect, the way that everybody in D.C. was claiming, what should happen to the quantity demanded? Well, if supply shifts back and price goes up, quantity demanded, quantity actually purchases go down. Well, take a look at these bars in the back. That's vehicles miles driven in the United States. And what don't you see? You don't see any change of vehicle miles driven, despite the fact that there was a 50% increase in gasoline prices. This is not a supply effect. It's a demand effect. And we all, of course, Remember that wonderful TV news story where they put the camera in this guy's face and they said, hey, how do you feel about filling up your tank? And of course he complained about it. Oh man, it's the world, they're terrible. Putin's awful, the Middle East is awful, Biden's awful. And then the newspaper guy would, or the TV news guy would just say, okay, thank you. And he'd walk away. And he would stop asking the next question. Where are you going? Well, of course, where he's going out with his boys to take his new boat out on the lake. And you might say, hey, but I thought you said gasoline was expensive. Yeah, we had to buy the cheap air. Well, of course, you don't have to buy the cheap air. Gavin Newsom gave you a check for your problems. But think about this just for a second. Take a step back. Why are gasoline prices so high? Because people have too much money to spend. What is our solution to the problem of people having too much money to spend? Give them more money. Again, this is not the right way of going. This is the craziness of public policy when, of course, the narrative is absolutely broken. And I can go on. I mean, how terrible was 2022? We all heard about how inflation was just crushing American households. And here's a couple numbers. For example, in 2022, off-site spending for alcohol in real terms had never been higher. Look at gaming revenues in Vegas. Never been higher. It's been so tough in the United States. People are driven to gambling and drinking, people. Again, nonsensical. We all know that if you go out to concerts, you go out to Las Vegas, you go out to the shows, it's packed. People are partying. And yet we sit around and look at these headlines talking about how tragic everything is when only thing we have to do is open our eyes to realize what's really going on. Look, 2022 wasn't a bad year. We had 2.1% growth, which is about the same as it was back in 2019. And most important, of course, the big source of growth in our economy, despite all that inflation, was consumer spending. Now, not all of consumer spending. Services was the big driver, of course, adding most of that growth rate, but still a very good number. The consumers didn't run away at all. Now, again, nobody could hear that story. I still remember towards the end of last year, this is, again, or beginning of this year, this is a graph I pulled out of the Wall Street Journal yet again. And of all people, they should know better than this. They talked, the headline on this graph was, the consumer is capitulating. How do we know? Well, they show you this scary picture. It's coming into the beginning of 2022, we had retail spending was growing almost 2% on a monthly basis. By the end of the year, it was contracting 1%. Very scary, the Wall Street Journal told us. But then let's take a step back and look at that in the aggregate. There's a giant increase here, and those two little 1% blips here, that's the pullback we saw there. Yes, of course people are pulling back on retail spending after an enormous surge during the course of the pandemic where you couldn't spend money on services. There's nothing particularly surprising here. And of course, actually, it didn't even matter because January came in and retail sales jumped yet again. Look, people are just going out and living their lives again. Here's one of my favorite statistics. Take a look on the left-hand side. This is retail spending at restaurants. Restaurant spending today is 40% higher than it was pre-pandemic. People are traveling abroad at exactly the same pace they were prior to the pandemic. Travel and hotels, whether you're looking in LAX or Ontario, busy. Hotels across Southern California, busy. Things are fine. Even in terms of goods, right? Take auto sales, for example. Last year was not a good year for auto sales, yet every auto dealer I know is smiling from ear to ear. Why? Sure, I'm selling 25% fewer cars, but my profit margins are up 100%. Why? The problem in auto sales is not a lack of demand, it's still a lack of supply. Back in 2016, 2017, there were 1.2 million cars for sale in the United States. Today, 108,000. That's it. There is still nothing to buy. In other words, what's happening here is there's still plenty of demand and the economy is still struggling to keep up with it. Inflation pressures aren't going anywhere. And you can see it out here as well. Take a look at index of taxable sales, particularly out here in the Inland Empire. Look at Riverside taxable sales, which has jumped a whopping 60% from the beginning of the pandemic because we're buying stuff online. You could see, of course, all the occupied warehouse space here in the Inland Empire. By the way, one of the big questions, is that going to go away? Well, no, of course not. If you take a look at industrial supply chains right now, we know people are buying things online, and that hasn't changed. You know, Pitney Bowes U.S. package delivery, 2016, 11 billion packages delivered in the United States, 20 billion in 2020, 21.6 billion in 2021. This is a new way of shopping, and it's not going anywhere. This part of consumer spending remains alive and well. But wait, I heard the consumer was getting crushed by inflation. Well, I heard that too, but it doesn't make a lot of sense. Only thing you have to do is take a step back and, well, let's just take a look at the inflation trends. First of all, let's acknowledge that this really hasn't been that big of an inflation surge. Over the last 5 years, we've had 1 year of bad inflation after 4 years of very low inflation. Aggregate over 5 years, about 17% inflation. If you go back to 1979, after 5 years, 50% inflation. That's real inflation. We really haven't seen inflation yet. And while interest rates are up, let's remember that most Americans' consumer debt is in the form of a 30-year fixed-rate mortgage. In other words, the increase in mortgage rates doesn't mean anything to them. By the way, that's not normal. Canada, the UK, they don't have those kind of mortgages. That is an American product. And of course, we're being shielded from this big increase in interest rates as a result of that. In fact, overall, the U.S. financial obligation ratio, which is a percent of disposable income spent on debt and various sorts of debt-like things like rent, well, still near a record low level. Now, for those who are telling us the consumer is about to dry up and go away, they'll tell you about how, income has been hit by inflation. The savings rates have dropped to 2%. But I already told you the answer to that. This is not about income, it's about wealth. We saw a little bit of a give back in wealth over the course of 2023, but not as much as you might think. American households are still up $30 trillion from where they were prior to the pandemic. There's tons of money for most folks. The stock market has come down, but say, for example, home prices, they've just started to go down now. So really, there's still a tremendous amount of new money out there Americans try to spend. And of course, this is my favorite statistic. This is household checkable deposits. This is basically what every American household together has in their checking accounts and savings accounts. Prior to the pandemic, all American households were hanging on to about $1.1 trillion in cash reserves. Because of the policies that were put into place over the course of the pandemic, right now, American households are hanging on to $4.7 trillion in sheer cash liquidity. Cash is king. People are trying to spend this money. This is what's driving consumer demand and what will continue to drive consumer demand regardless of inflation. And you might say, well, hey, maybe that's all just the top 1%. Again, if you look at the top versus the bottom 50%, they both have plenty of new money. This economy is up to its eyeballs in cash reserves, and that is at the core of ongoing strong consumer demand. And you can see it, for example, consumers with credit issues. Look at foreclosures and bankruptcies, staring at an all-time low level. Take a look at the population with the subprime credit score out here in the Inland Empire. The numbers are fantastic. This is not a population of consumers that's struggling. Quite oppositely, they still remain some of the strongest consumer fundamentals this nation has ever seen. But what about the scary stories about credit card debt? Again, it's just miserableism trying to create a scary story out of nothing. Take, for example, on the left-hand side here, this is consumer credit in trillion. And yes, credit card debt is starting to go up only after dropping sharply over the course of the pandemic. It still hasn't gotten back to the trend it was on prior to the pandemic. What about credit card delinquencies? I hear they're up. Yes. They're almost back to the record low levels they were at prior to the pandemic. It's not scary. Look at the data. They're trying to make it scary when in fact it's just getting back to normalcy. Now, one of the big questions you might want to ask me is just how far inflation can go given the strength of the consumer. And the answer is it's got a ways to go. If you just look at the money supply, because that's what causes inflation, we already had that conversation, we're looking at about 8 to 13% more inflation. Now, it's a relatively wide range, and let me explain. When you think about inflation, you got to worry about what's the Fed going to do? How much real growth are we going to have? What's going to happen to the change of velocity? There's a lot of things you have to think about. But if you just look at the basics of nominal GDP compared to the money supply, 8 to 13% kind of gets us back to where we should be. So we're halfway through it, but we're not all the way through it, which of course brings me to the Federal Reserve yet again. Because the Federal Reserve, of course, has reacted very strongly to the stories of inflation. They have heard from everybody that they're very upset. Congress is upset about inflation. You have to do something about inflation. And what have they done? Well, they have, of course, turned around and increased the federal funds rate from functionally 0 to 5% as of the last increase. So, again, one of the sharpest increases in the federal funds rate we've ever seen. And the market buys it. If you look at inflation expectations, they've been coming down. Now, to me, I don't quite understand this yet again, because my understanding is that inflation is driven by money supply. And the one thing here we got to keep in mind is the federal funds rate, That's an interest rate, an overnight interest rate that banks basically pay each other or pay the Federal Reserve to move reserves around. It has nothing to do with the supply of money in the broader economy. Ergo, the only thing the federal funds rate actually does is change the pace of price adjustment, not the actual amount of it. So in other words, you can crank the federal funds rate up from 0% to 5%, but the only thing you've done is, say, taken that 8 to 13% more inflation and spread it from 2 years to 3 years. You haven't actually impacted where prices have to go to get back to basic price stability. You haven't changed any of that. Now, of course, let's get back to that story of the inverted yield curve. Remember, I brought that up a little while ago. And yes, it is true that prior to recessions, we typically have an inverted yield curve. But why? Well, again, it's not because the inverted yield curve causes a recession, but rather the inverted yield curve is telling us something about what the Fed is trying to do. If you think about the past couple times we've seen an inverted yield curve, it's typically because they are responding to some negative episode in the economy. For example, the inverted yield curve we saw back in 2006 was driven by the Federal Reserve worried about subprime, worried about the real estate bubble, and trying to cool the economy off. This time we have an inverted yield curve because they're worried about inflation. It's due to, of course, Fed policy. Now, that brings me to some questions. I'm a little philosophical. Lance doesn't like philosophical questions, but I have a few for him today. Things to think about tonight when he's trying to get to sleep. For example, does free will truly exist? We're not clear on that. We're not clear. How about why is there a D in fridge but not refrigerator? Again, we're not clear on this. This is a mystery. Does expecting the unexpected make the unexpected the expected? We're not clear, yet again. And then, of course, last but not least, if the Fed inverts the yield curve and the economy is otherwise fine, will it cause a recession? Well, I would have told a couple of years ago, I would have said this one, absolutely not. But now, I'm not quite so sure, and that brings me, of course, to what's happening in our banking system. Well, let's all go back to a few weeks ago when Jerome Powell finally recognized that the big increases in the federal funds rate weren't actually slowing down inflation very much, and he said, hey, we're going to have to raise them even more. And we know, of course, that suddenly there was a big panic in the market, and net result of that was Silicon Valley Bank ended up folding. Why? What happened to Silicon Valley Bank? Well, we have to first take a step back and recognize that there is a second part to Fed policy having to do with inflation, and that was, of course, quantitative tightening. Now, quantitative tightening is the opposite of quantitative easing. Quantitative easing, you buy treasuries with newly printed money. Quantitative tightening, you're basically selling off the treasury you just bought, thus taking cash out of the system. You're shrinking the money supply. Now, this would actually truly cool off inflation, because remember, it's a monetary phenomenon. You shrink the money supply. Also, that's the way you go. And they did. They started to, at the end of last year, after the federal funds rates, they pulled about $600 trillion out of the economy. And as a result of that, they're increasing M2 by 40%. They pulled M2 down by about 4%. So what does that mean for the banking system? Well, let's take a step back. Remember, at the very beginning, $5 trillion in quantitative easing, $5 trillion in new money thrown at the economy. Where did that money go? Now, they gave it to households, they gave it to businesses, they gave it to airports. But take people, for example. What do they do with the money? Well, you paid your rent, you bought gas, you bought a new boat, you invested it for your 401k. Whatever you did with the cash, where it inevitably had to end up was, of course, in a bank. And that's exactly where it ultimately ended up. You saw bank deposits go up by about $4.7 trillion over the course of that huge increase in money supply. That's a big number. That's like 35%. Now, what do banks do with all those new deposits? That's a tough question because you can't, of course, lend it all out, particularly not in a cash flush world. There's not a lot of demand for loans. So you do exactly what you're supposed to do, and you invest it. That is to say, you take that money and you buy ultra-safe securities, debt, GSE debt, government debt, the safe stuff, because that's what the Federal Reserve has told you have to buy. Now, that's all well and good because, that stuff is safe unless, the only reason those securities would not be safe is, for example, if the Federal Reserve should crank the federal funds rate up from 0 to 5%. Because when you increase, of course, interest rates, what that does is substantially diminish the value of those particular securities. And even there's not a real problem because banks don't have to do what we call mark to market. They can hang on to the security at its face value. It doesn't have anything on its balance sheet. Yes, in the long run, they'll take a bit of a profit hit, but it's okay. Their balance sheet's just fine. Unless, of course, they're forced to sell it. Now, that, of course, is where things start to get very, very interesting. And with that in mind, there's something else I think we need to point out. Take a look at the right-hand side here. This is the delinquency rate for commercial banks in the United States coming into the fourth quarter of last year, and it was the lowest it has ever been. So if you're wondering if there's a problem in our banking system because of some underlying problem in underwriting, the answer is no. That is not the issue. The issue has something to do with, of course, the balance sheet here. And it boils down to this. So again, in the run-up here, $4.7 trillion in deposits, 35% increase, of which they put $1.9 trillion into securities. That's about a 50% increase. And then starting of July last year, they just began to ramp up quantitative tightening, and suddenly what happens? Well, loan demand goes up because we're no longer cash flush and people need cash. Deposits have started to fall. Why? Well, the same way as quantitative easing inevitably puts deposits into banks, quantitative tightening inevitably must pull deposits out of the banks. So you have an increase in loan balances, a decrease in deposits. How does the bank balance that? You have two options. You go to the market for extremely expensive capital, or equivalently, you sell securities. But if you sell the securities, you sell them at a loss. And that's what causes the banking crisis. So let me kind of sum it up this way. The Federal Reserve packed the banks full of securities, then they diminished the value of the securities, and then they forced the banks to sell those securities. That's, of course, exactly what happened to Silicon Valley Bank. Now, Silicon Valley Bank was an extreme example of it. Their deposits went from 80 to 180 billion. And of course, most of those deposits were large, coming from venture capital companies, and they were all highly integrated. I heard all that. I get it. But remember, Silicon Valley Bank was simply an extreme version of the pressures that all banks are under right now. And that begs the question, what is the Federal Reserve doing? Well, if you back up, go to the Federal Reserve's website, and this is on their website. What is the Federal Reserve supposed to do? Their three primary goals are: one, price stability, we all know about that. Two, full employment. Yep, back in the day they decided they also have to be in charge of making sure that people can get jobs. And then last but not least, they are the stewards of the banking system. They are there to make sure the banking system remains whole. They regulate banks. Now, the problem here with having those three missions is those aren't necessarily aligned. Doing one can hurt another. Hence, the Federal Reserve has to operate slowly, make calculated decisions, understanding the full implications of their decisions. This Federal Reserve is clearly completely incapable of that basic managerial role. Look, a couple of years ago, in a preposterous panic over full employment, that the pandemic was going to cause a depression, they completely blew up price stability with $5 trillion of quantitative easing. And then, in a ridiculous panic over price stability, they cranked up the federal funds rate from 0 to 5%, and of course, they're having an incredibly negative impact on the banking system. They could not be handling the money supply in the banking system any worse. And then, of course, when I look in the paper and I see Fed's bar calling Silicon Valley Bank a textbook case of mismanagement, well, needless to say, what I think in my head is, that's rich. Unbelievable. And of course, scary. This is what happens when an incredibly important institution like the Federal Reserve becomes politicized. They start chasing the narrative and they start doing more damage to the economy than they're actually, relative to what they're actually helping. And now that brings me, of course, to the conversation about banking. Because when you think about banking, and particularly over the last couple of quarters, what do you know? It's suddenly become really hard to get a loan. Look at increasing standards on commercial real estate loans. This comes from the Senior Loan Officer Survey, way up. Increasing standards in C&I loans, way up. The one place you're not seeing big increases in standards is actually mortgage lending. What's going on here? Well, think of it this way. If you go to a bank and you want to get a big loan to buy, I don't know, an industrial warehouse, they're not worried about you paying that money back. That's not the issue. The issue is not paying the money back. It's not credit risk. It's the fact that the money they're going to give you is incredibly expensive because they're going to have to borrow it or they're going to have to sell off some securities at a loss. They don't have the money to give you, hence the markets are getting gummed up. That's not true for residential real estate because residential real estate is a commoditizable loan. It's something you can sell off, you can get off your balance sheet. Hence that market's flowing, even though these other kind of markets are not. So it's an interesting kind of shock to the credit system. And of course, when you think about non-residential, we've heard a lot of scare stories, but if you take a look at the numbers, take, for example, of office vacancies in the Inland Empire, they're down over the last year. Vacancy rates for a warehouse continue to be way down. The only thing you're seeing a little bit of weakness on is on the retail front, but then again, retail's been in a crisis for 15 years. There's nothing new here on that particular front. Inland Empire, non-residential permit values were actually up last year. Very good numbers to say the least. So the problem in commercial real estate we're seeing right now is not a function of underlying supply and demand. We didn't overbuild the way we did in the run-up to the Great Recession. The problem here, of course, is a pricing issue. There's a pricing issue because in the course of the pandemic, cap rates got pushed down to ridiculously low levels, and now they have to come back up again. And just as those cap rates are coming back up again, credit is suddenly becoming very tight because of the Federal Reserve-caused banking crisis we're dealing with. So yeah, it's a problem from a financial standpoint. You see it. Brookfield just defaulted on $784 million of loans. But this is not the case. Commercial property losses will add to bank loans? I don't think so. This is not the issue. Banks have been very, very conservative in lending. The issue here, of course, boils down to, yet again, the Federal Reserve and the choices they are making, the strange choices they are making. And to be clear, there are plenty of signs of stability. The bond market distress indices still look very good. This is not a typical credit crisis we're dealing with. Typically, credit crisis starts with the borrower. This time around, our credit crisis is starting with a lender. It's a different kind of cycle. And, it's the same thing for businesses. And for all the negative news you're hearing in the headlines about the implications of Federal Reserve policy, businesses are doing great. In fact, businesses are making money, they're investing a lot. The biggest issue with businesses right now is the fact that they still can't hire enough people. Now, we've talked about this plenty of times in the past. I don't have to reiterate this. Why do we have a labor shortage right now? Demographics. Boomers came out of families of 10 kids. They had one kid. Now boomers are retiring. There's one Gen Z coming into the workforce. That's not enough. So our overall outlook for growth in our people in prime working years, according to the census, is basically flat for the next 25 years. But it became, of course, a crisis during the course of the pandemic when a couple million people decided to go ahead and retire. That is when these labor shortages hit home. That's when it became, of course, the real deal. Now, are there upsides to this? Well, yes. Depending on where you are, shall we say, within the labor markets. If you're earning, that is to say you're on the worker side, the paycheck side, you're doing great. Take a look on the left-hand side. This is real earnings growth. And by the way, it's not true that real earnings growth is negative right now. In fact, quite the opposite. It's roughly positive. But what's interesting, is who has positive earnings growth and who doesn't. Turns out the bottom 50% right now are seeing their real earnings grow by 2% year over year, whereas the top 50% basically flat over the course of the last year. Yep, if you're looking at this graph right, it says to us that income inequality is falling dramatically over the last couple of years. But by the way, that's not anything particularly new. If you go back in time, really the bottom half of the pyramid started doing slightly better than the top half going back to 2015. Yes, income inequality has been falling for 8 years, and that's a story you will never, ever see in the New York Times. Now, I said there's two sides of this equation. The other side is if you're trying to run a business, well, your labor costs are going through a roof right now. And even then, you're not able to get enough people in the door. So the cost of labor is going through the roof. Earnings are better, particularly for lower income earnings. Well, that's the nature of our labor market. And by the way, this is good news for the Inland Empire, particularly since it's a home to relatively, shall we say, less skilled workers than those more uppity coastal areas, as the case may be. You see good solid numbers out here. For example, if you go back to 2019, average weekly earnings here in Riverside were running, a little less than $900. Today, they're well over $1,000. You see that in many of these inland communities. I already showed you this graph before about the share of local population with a subprime credit score. It's never been lower. Again, things are fine here. We got some earnings numbers from 2021. This is changes from 2017 to 2021, and you can see particularly those with a less than a high school degree, earnings growth in Riverside over those 4 years, 35% and 36%, the highest of any education level. Again, very good numbers for lower skilled, lower paid workers. And yet again, this turns immediately into consumer demand. They don't save, they spend. And that's, of course, it goes back to the idea that consumer remains very strong right through this. In fact, labor shortages are one of the reasons that we're seeing very good numbers, particularly in business investment, such as software and information processing equipment. Businesses have to invest right now to deal with labor shortages. And by the way, that's great for California's economy, because who sells software and information processing equipment? We do. So, good news on that particular front. Yet, of course, we still have to be afraid of that narrative. You know, Americans are going to lose their jobs to AI. Yet again, broken narratives. As opposed to who's behind, if you take a look where California is relative to, say, we were 3 years ago, we're roughly middle of the pack. We're up 2% from where we were pre-pandemic. Idaho and Utah are up 9.5, 9.9 and 7.7. Maryland's down here at negative 2.7%. A pretty broad mix. But, you know, put this to one side. It's absolutely irrelevant. I get so tired of Texas and California having their big conversations about who has the bigger economy and who's growing faster. Here's the key. Everywhere you look in this nation, the one thing that every part of this economy has in common, whether you're rural or urban, coastal or inland, blue or red, everybody has help wanted signs. Labor shortages are everywhere. And what's interesting is the biggest increases in labor shortages we're seeing are actually in the places that have seen, shall we say, not the same recovery. Whereas places with a more rapid recovery are actually seeing a smaller increase in labor, in an overall job openings rate. What's up with that? Well, again, it's a function not of whose economy is strong and whose economy is weak, but which economy has workers and which economy doesn't. Growth right now in the United States is a function of overall labor force growth. Everybody has more job openings. The question is, who has the workers? And California doesn't have workers. Texas does. Why? What's the big story on this? Right here on the left-hand side. You want to know Texas versus California in a nutshell? There it is. We build housing. They don't. Ergo, they have growth in their labor force. We don't. And, of course, this is where our labor shortages come from. And today, of course, when you think about housing, understand that California's housing vacancy has never been lower than it is right now. This is our labor force challenge. We don't have enough housing to house the people we actually need. Now, when you look across California, yet again, it's a very distinct picture of haves and have-nots. Not the old have and have-nots, you know, Orange County versus Fresno, but rather the new kind of have and have-not, have workers, don't have workers. In this case, Fresno has them, Orange County doesn't. Hence, of course, when you look at labor force growth since the big pandemic began, Stockton, top of the list, 10% growth. Inland Empire, 5.5% growth, second most rapid growth. Fresno, number 3, Sacramento, number 4. Not until you get to San Diego and San Jose do you see a major coastal economy with a positive growth rate. But again, the function here is labor force growth. The places that have built housing, see labor force growth, can see payroll growth at this point in time. Looking at local jobs, again, great numbers, up 5.5% over those 3 years. Driven in large part by a 32% increase in jobs in logistics. 50,000 new jobs in logistics, over half of all new jobs in the last 3 years in that one sector. But then you get professional scientific services. Great jobs for the Inland Empire. Admin support, healthcare, construction. Good jobs forming out here in the economy. Now, some are suffering. Information's way down, but that's a small part of the economy. Education, government, manufacturing, their problem is mainly they can't, again, hire workers. Now, it's interesting. For all the good news about logistics, what do you hear? Well, you hear 60 organizations urging Governor Newsom to declare a public health state of emergency in the Inland Empire because of all those new jobs you got. Again, interesting narratives. In the Inland Empire, logistics has been an enormous source of growth for the region. Yet, of course, there are plenty of people out there that think it's a tragedy that the Inland Empire should have these jobs. A strange world we live in. Anyway, the big story, of course, out here is the unemployment rate in the Inland Empire and LA are both running about 4%, the tightest they've ever been. The big gap between, of course, Inland Empire and LA over the last 20 years has been the fact that you've seen, of course, a lot of new job growth out here, driven yet again by that big increase in labor force. It's a very simple story. The Inland Empire has been one of the strongest most rapidly growing economies in the state of California, an enormous lift because, of course, of the ability to continue to expand its workforce. But that can only continue as long as there's enough housing. And yet again, the story I've told you over the last bunch of years is the biggest problem we have in the Inland Empire is there has not been enough housing being built. And back in 2007, there were over 20,000 permits. The best year we've had since was in 2021 with 15,000 permits. It needs to be a lot more than that if this region is going to continue to expand its workforce to allow, of course, more jobs to form. This is the bigger issue. And of course, it's an issue we've got to worry about, particularly given the state of the housing market. Now, where's the housing market since we started with the permits? This is why we're all here. Well, housing markets are damn cold. We know that. Overall, home sales are way down. Case-Shiller prices are starting to turn negative. It sounds very scary. And in fact, of course, some folks might think that this is the beginning of another big real estate cycle, the way we had in the middle of the Great Recession. We see a big increase in inventories for new single-family homes. Single-family housing starts are starting to fall. Again, I get it. Looks a little bit too much like what happened back in 2007. But put that to one side. This is not that housing cycle, not even close. It couldn't be more different. Look, the only thing this housing cycle and that housing cycle has in common is that they both started with a big increase in home prices. Now, mind you, it happened about over 6 years prior to the Great Recession. This time around, of course, it was really only about 2 years. But otherwise, you had a big increase in prices. That's where the similarities end. How are they different? Well, in so many different ways. For example, this time around, the big issue with our housing market has to do with that big increase in mortgage rates. Remember, they went from 2.5% to 7%. Suddenly, a big price shock. It becomes much more expensive to buy that particular home. That is why people are pulling back. It's expensive. That's not at all what happened during the Great Recession. In fact, over the course of the Great Recession, mortgage rates fell, and it didn't make a lick of difference. Because what pulled the housing market back down then was, of course, there was too much supply, a lot of bad debt, and the net result of that was you just had a housing market that absolutely imploded on the basis of all these foreclosures. It got pulled down by this crazy number of empty units just sitting around mildewing. None of that happening today. And again, I get it. Prices are starting to come down just a little bit, but really just a little bit. They're coming down just a bit from the incredible highs they hit over the course of that big run-up. As for, a wave of foreclosures, putting tons of units on the market for sale, not going to happen. Back then, again, the housing market was pushed forward by a huge amount of new debt, particularly subprime debt, that was going to everybody in any amount of quantity, regardless of the actual credit worthiness of that particular borrower. This bubble has not been driven by debt at all. It's been driven largely by cash. A lot of cash demand out there. People are just rolling money forward. Put this in context. 10 years ago, there was about $9 trillion in equity in all U.S. real estate. As of the fourth quarter last year, $30 trillion of equity, one of the lowest debt-to-equity ratios we've ever seen. This market has plenty of cushion. No one's going to get foreclosed on. And of course, for that debt that's out there, it's about as clean as it's ever been. If you look at the share of household debt above 720 FICO, incredibly clean on that front. And the other big difference, of course, has to do with the supply of homes. If you go back in time and you look at what happened to the big meltdown, at one point in time in the U.S., there were 10-month supply of homes. During the course of the pandemic, it went from a very low 4 months to 2 months. And just now, it's not even back to 4 months. Overall vacant units for sale, incredibly low. Overall vacant units for sale for rent, incredibly low, some of the lowest we've ever been. This is not a housing market that has an excess supply. And quite the opposite, this is a housing market that doesn't have nearly enough supply. And that, of course, yet again, brings me back to the big difference between this housing cycle and the last housing cycle. If you want to know what the problem with housing markets were in 2010, you couldn't find any buyers. Housing market of 2023, you're not going to sell any sellers. You're not going to find any sellers. That is your big issue. There are no sellers out there. And of course not, because to sell your home right now means you have to go out and buy another home, of which there's not a lot of supply. And of course, you're going to have to do it at a substantially higher interest rate. And that brings me to, of course, the conversation about housing shortages and how this situation is going to cause the housing shortages in California to become worse. Remember that No. One of the biggest oxymorons in housing policy is the term affordable housing. Right? You hear it all the time. We have a shortage of affordable housing. No. We have a shortage of housing, which has an impact on its affordability. It's completely different. It's completely backwards. In fact, some of the least affordable housing out there is affordable housing units, because once you get through all the ramps and piles of rules and regulations on affordable construction, it becomes the most expensive house ever built. But put all that to one side. When you think about how housing markets operate, builders typically build at the top end. They build the fancy thing, and that's okay. We're told, well, that's not good. It's not good because it doesn't give more affordable housing. And no, it does. Because when you build that fancy new unit, these people move here, these people move here, these people move here, these people move here. They move up. That's filtering. You build at the top to supply at the bottom. Now, if you want to see how that works in the reverse, well, if you don't build at the top, what happens to people who want housing? They gentrify. They go into your lower income, lower cost zones. They buy those homes, make those neighborhoods more expensive, and drive people out. So again, you build at the top to supply at the bottom. You don't build at the top, you take away supply at the bottom. And that brings me to the problem in our housing markets today. How many people are going to sell their existing home to go down the street and buy a fancy new home, thus turning in their 2.75% mortgage rate and trading up for a 7% mortgage rate? They're not going to make that choice. They're not going to move. They're going to sit on their hands, and as a result of that, a big decline in liquidity. And of course, that means more potential housing shortages at the bottom of the market. That is a big problem for a state that is already housing constrained. This is going to make that particular issue that much worse. It's also tough for real estate agents because, again, the problem out there is that there is nothing to sell. People aren't going to move. There's going to be an incredibly tight supply of units. And don't believe me. Just take a look at some of the more recent data we have. You have Case-Shiller numbers. This is for LA, but it's pretty good. And you can see it just started to come down just a little bit. Active listings in Los Angeles and Inland Empire, significantly tighter now than they were back in 2017. Median listing prices have barely budged. People are not capitulating. They're sitting on their hands. They will wait till the price they want, and otherwise they won't sell. So yes, this is going to be a housing cycle like we saw in the 70s. And that kind of housing cycle was not marked by a big decline in prices and a ton of foreclosures. That was a housing market that was marked largely by a big decline in liquidity. People simply didn't buy and sell as much. They sat in their hands, and as a result of that, the industry got very, very cold. And by the way, this isn't a good thing for a number of reasons. I already told you, like for one, it's not good because we're going to cause more housing shortages at the bottom end of the pool. But of course, the other big problem with it is if people can't move, it makes life choices that much harder. It's tougher to take that new job. If you do, maybe you're going to have to commute an hour. I certainly can't sell the house and be closer to that. And when you have that lack of liquidity, you have a bigger mismatch between the housing supply and housing demand, yet again creating bigger problems. This is not a good thing for anybody, and of course it's something we need to be paying attention to. It also, by the way, explains why apartment markets are so incredibly strong right now. I mean, after all, if you look at rents, they're up. Vacancy rates are down. Starts of 5+ unit buildings up. These numbers are off the charts. Good stuff tells me apartments are rocking and rolling. But again, why? Well, go back to a couple things we talked about. First of all, no one's getting in owner-occupied housing right now. If you're trying to make the jump to buy your first home, couldn't be a worse housing market for you. There's no inventory, interest rates are incredibly high, and costs are not coming down. So a lot of folks, well, they're just going to stay in their apartment. And by the way, remember the other side of it. I already showed you 100% plus increase in net worth for the bottom 50%. Bigger earnings increases for workers in the bottom 50% than the top 50%. In other words, demand for housing is incredibly strong, particularly rental housing, because that's where the bottom 50% typically lives. So you have a very odd market. Take a typical apartment building. Is the price going to come down? It has to. I mean, after all, cap rates were 2%. That's not reasonable in a 7% mortgage world. Yet at the same time, the dividend on that apartment building, that is to say the potential rent you can get out of it, is better than ever because of the strength in overall consumer demand. And you can certainly see it. Overall rental vacancy rates, look in California, 4%. In the U.S. overall, 6%, one of the tightest rental markets we have. And of course, overall total rental units, what's interesting is for all the stuff we're building, total number of units for rental units for sale or rental units out there in the market actually hasn't changed much over the course of the last few years. Why is that? Well, yet again, here's something that is, I think, very relevant for the Inland Empire. And it has to do with the fact that over the last few years, while we've added 1.5 million new multifamily units, 1.1 million single-family rentals have been converted into owner-occupied units. So yet again, rental markets remain incredibly tight, and as a result of that, of course, well, rents continue to rise. You take a look at here in the Inland Empire, for A space in particular, it's interesting. If you look at the A versus BC space, A space vacancy rates are down 1.4 percentage points. The BC is up 0.8 percentage points. Why is it up here and down here? Well, yet again, it isn't just that there's overall more demand for housing, but it has to do with the fact that people are wanting better housing. And that brings me to one of the big stories that you've seen over the last couple of weeks. Population numbers came out for 2022, and they weren't good. Population fell pretty sharply in LA County yet again. In Riverside County, they came back just a little bit, but still below where they were in 2020. And it begs the question, what is going on? Because remember what I just told you. Supply of single-family homes, non-existent. Supply of apartments for rent, very, very tight, despite all the new stuff we built. Yet population is falling. Now, if population is falling, shouldn't housing vacancy rates be going up? What's going on here? Well, yet again, it's a conversation about demand. Because think about, for example, a typical renter, maybe somebody 30. Well, if you're 30 and you don't have too much income, well, maybe you're going to have a roommate. But now your earnings are going up, you have more earnings growth, what are you going to do? First thing you do is you throw your roommate off, you want to live alone. And so what you have is the demand for housing causing people to spread out. And as you spread out, of course, that actually pushes people right out of the area completely. So in the midst of strong consumer demand, which is increasing housing demand, we're actually causing the number of people per household to fall, which of course is causing, well, vacancy rates to remain very, very tight. So again, it's not the kind of market, it's not the kind of housing cycle you're typically used to. This is a housing cycle that is going to be marked by, I know it sounds odd, but falling prices to some small extent, very, very little liquidity, but at the same time, one in which there is almost no supply available. So it's supply. And boy, this is something policymakers have to get into their heads. Nothing worries me more for the state of California than the narrative wrapped around rental price increases we're seeing. The narrative is rental price increases are hammering renters. The reality is strong demand for renters is causing rental prices to go up. Why is the narrative dangerous? Because the state's going towards rent control. And if you think our supply problems are bad now, wait till they throw out Costa-Hawkins, and suddenly no one is willing to build more multifamily in this particular state. Again, now more than ever, we have to get in front of correcting this narrative before policymakers do more damage than they actually do good. So with that, look, expansion is going to continue. Wealth and income is going to drive consumer spending. Business spending is going to offset labor shortages. Asset values are to fall. Liquidity is drying up. Inflation will continue to run hot, but ultimately the core part of the economy will remain strong. The economy is going to continue to grow as long as the Federal Reserve backs off, which I'm going to come to in just a second. The Inland Empire and real estate, well, again, the local economy is not some blue water backwash that desperately needs the help of Sacramento to, save its residents. Quite the opposite. This remains one of the hottest economies, not just in the state, but the nation. It is rapidly growing. It's got an incredible amount of upside. It's got lots of income growth. If you consider the cost of housing here in the Inland Empire, it provides the best standard of living of any part of Southern California. So the Inland Empire continues to be an incredible place to do business. But real estate's losing liquidity. There's a big lack of sellers. Demand for housing is going to remain high. The question is will this economy allow the needed housing to be built? The one thing that's really worried me about the Inland Empire over the last few years is they've started to indulge in the same kind of NIMBY nonsense that has caused both the LA and Orange County economies to start to stagnate. It's not the time to do it. This is an area that needs to continually heavily invest in real estate, and that is, of course, the key to its future. Now, where do we go? What happens after this? Well, the most important question we all have to ask ourselves is what will the Federal Reserve do next? Because you got to remember, Jerome Powell has put himself between a rock and a hard place. The rock is very simple. If he continues to fight inflation through quantitative tightening, he's going to cause a major banking crisis, and that will have implications for our economy. A complete unforced error. This is a nation that does not need a banking crisis, but he could cause one. Could it cause a recession? Let's not find out. Let's not find out. But let's not forget his hard place. His hard place, of course, has to do with inflation, or more particularly, the politics of inflation. Understand, Americans are not suffering from inflation. Americans are causing inflation because of the excessive amount of demand, because of the excessive amount of cash that the Federal Reserve gave them. But no one can say that out loud. And as a result of that, of course, politicians will respond not to the reality that consumers are pushing inflation, but the perception, that is to say, people are angry about inflation. I mean, after all, hey man, my ship just came in. I'm rich, and I go out to buy something, and everything's expensive. That's not fair. Well, that's the situation. When there's more demand than there's supply, prices have to go up, and that is our nation right now. Yes, it makes voters angry, and that, of course, is the scariest thing for Jerome Powell. And because look, in 1 year, we're going to be going into an incredibly contentious presidential election. And you know that the people not in power in the White House are going to make inflation an enormous issue. And Jerome Powell is going to be squeezed by this administration to do something about it, despite the fact that he really can't, at least not without causing a credit crisis. So, what are you going to do, Jerome? Which way are you going to go? You can let inflation run, and of course let banks be solvent, and the economy will just fine. Or you can fight inflation, cause a banking crisis, and hurt the economy. From an economist's perspective, the answer is obvious. From a political perspective, it's a coin toss. I don't know where he's going to go. You need to pay attention. Of course, we do have the national and local fiscal situation. Let's not ignore the global situation with China and Russia. Yes, we have a bit of a brittle economy right now because of the transfers of wealth. But again, scariest thing of all, the narrative. The narrative continues to be highly adrift from anything resembling reality, and we continue to pursue the wrong goals. This is not good. Look, Mark Twain said it best. It's easier to fool people than convince them they have been fooled. Or perhaps it was JFK who said, the great enemy of the truth is very often not the lie, deliberate, contrived, and dishonest, but the myth, persistent, persuasive, and unrealistic. There's a lot of myths in our world today, and they're doing a lot of damage. It's time for us to try to get the narrative pushed back to something resembling reality. So go out, ignore the weapons of mass distraction. Remember, it's going to be a tough year in real estate. There's no doubt about it. But the kind of issues we're talking about can be helped if the Federal Reserve just sits back. If they continue their policies, the crisis is just going to get that much deeper. Thank you very much, and we'll see you next time.